Welcome to Upside, where we dig into the real news that lives behind the headlines affecting European venture. This week, it is another full house. We have Mads, you have Lomax, you have Andrew and myself. And we're talking about, should governments buy stocks? Vinod Khosla, the world-renowned VC, thinks that we should. What to expect in the UK budget. We're not, boys and girls, I promise we're not going to do too much in this, but what's going to happen? Maybe we can focus on just the founders and investors. Should founders be raising right now to preempt the market correction? If there is one, who knows? We have AI Corner, we have Deal of the Week, but to start with, let's do a round robin on some of the news. I'm going to throw some things into the pot and see if anything piques our interest. Now, to start, I saw something. This came from you, Mads, a tweet that you liked. 23% of new unicorns in 2025 have been European. So our slice of the unicorn pot has been growing steadily over the last 10 years. US is steady as she goes, but no growth, and Asia is slipping. We had I don't know if you guys saw the CTO job ad for 100K. For the UK government CTO. I don't know what they were going to get for 100 grand, but bless them on that. The IMF, this is possibly not affecting us, but I'm going to share it anyway because it caught my eye. IMF reckons that US debt burden is going to hit 143% of GDP by the end of the decade. Currently, it's about 119%. I also saw this week that Lakestar is not raising any more funds. Sequoia has raised 950 across 2 funds, but only 200 million for seed. I don't know if there's anything in there that we want to pick up on. Also saw Sequoia this week, Botha from Sequoia, saying that venture capital is not an asset class. I didn't quite know what that meant. He also added, throwing more money into Silicon Valley doesn't yield more great companies. Maybe there's something to pick up in there. And then Lomax, I saw that you noted that Bending Spoons, the marketing tech roll-up, has just bought Vimeo and is set to buy AOL for 1.5 billion. They've only been around 2013 and bootstrapped, I think, until 22, 23. So they've had 50 plus acquisitions since then. So good on them. Anything in there, Lomax, let's start with you. Anything in there that you pick up on?
Jesus, lots.
Yeah.
Well, but first of all, Bending Spoons is equity, as they also conducted an equity raise at 11 billion equity valuation. I mean, clearly a lot of these acquisitions have been fueled by debt. So Bending Spoons has actually been funding a lot of these acquisitions by debt over the years. I mean, in a way, it's sort of become a kind of Berkshire Hathaway of consumer apps. It's a very interesting model. There's actually a similar company in Ukraine doing a similar thing called Gentek, which I would suggest checking out, which is a kind of little brother or sister to Bending Spoons, similar strategy. But this is really, tech gone full circle, bending circles, buying AOL. And it's it's not the classic scale from zero single product company, but it's certainly an interesting strategy. So
I thought we'd see many more after COVID. I thought we were going to see loads more of M&A after, and we didn't really see this roll-up strategy. I think it's really cool.
Yeah, I would also picking up on the other things. I mean, unicorns, great. It's all about Decacorns these days, guys. Come on.
Oh, come on, man. Come on.
The US debt thing is very interesting. I think in the sense that, and we have talked about this before as a group, is US debt is now, as you say, projected to surge past that of Italy, which has historically been the kind of poster child for fiscal ill discipline. However, I think Europe is actually still seen by many as the riskier trade. So in a way, why is that? I think at the moment there's a belief that the US effective, if you looked at these as perhaps companies, the people believe that the US are just better at capital allocation than we are in Europe, for example. So I think that's maybe
better
Europe
growth,
is a little
right?
bit. Maybe Europe is yes, but that includes capital allocation and investment, and I guess the dynamism in the US. And maybe, if you looked at the public markets now, Meta, which is now being slightly beaten up in the public markets, is a little bit like Europe, where people are asking questions about where they're going, whereas clearly NVIDIA or Google, perhaps now looking at these latest earnings reports, are more like the US. I thought the asset class point by Rodolphe Botha was a really interesting one. The point he's making is it's not so consistent that you pour more money in the top and predictably more money comes out the other side, or there's not a kind of homogeneous set of behaviors that govern this asset class. And he's very right. I think one of the points he was also saying is that really in venture, there are only and still only will be a very, very small number of big companies that deliver 70 to 80% of the returns. So you can put more money into the asset class, but if that money doesn't go into those companies, then it's not going to deliver the returns that you would expect. And so all of the returns will consistently come through this sort of vortex of 5 to 6 massive companies that emerge per vintage, and everything else is by the by, which it's so heterogeneous, he's saying, and inconsistent that you could not call it an asset class in the way that you might call commodities or real estate. But
well, it's not linearly. I can't say it.
Yeah, there you go. There you go. Be a teeth in, dude. Come on.
Scalable. I went to a speech coach when I was a baby, so give me a break. It's not linearly scalable. So from that point of view, I mean, yeah, it's not an asset class, but I also feel there's a bit of PR going on here. I feel as though high-profile investors often make provocative statements.
Of course, they sit
to
on the
shape the narrative,
stage,
to guard their reputation,
They
to
do.
stay on the page. I mean, it's not quite Trump-esquian, but you know, people who have reputations, and it's a great way of keeping in the headlines, and that's important to Sequoia just as anybody else. So I hear you that the number of $100 billion companies or even Decacorns is not exponentially increased with, increased in line with the amount of capital in the market. And so you're going to have an awful lot of VCs who do not perform well potentially, and you cannot just inject more money into Silicon Valley and expect there to be an even spread on winners. You know, you can't cookie cut 1,000x Jason Calancalises from Uber Investments, right? It's still a power law. But of course, it's an asset class. I mean, you could equally compare anything else and say it's horses for courses. So I think it's a bit of PR spin here, and I think it's a great conversation to have.
Matt, you're quiet. What would you pick up on?
No, I just say 100%. Look, here's a big surprise, right? Successful venture capital investor in Silicon Valley doesn't feel he needs more competition. Well, there's a surprise.
What a great pithy summary.
Yeah, you got Lakestar and Klaus. You know, successful European venture capital investor now prefers to invest his own money as opposed to raising money from other LPs. There's a surprise.
While raising $500 million to put into growth at parts of successful companies, and while still investing into other VC funds, and while we're also just reporting that the European VC ecosystem has increased 5x in the last 10 years. So I agree with you.
Yeah. I mean, look, a bit of headline grabbing there. Absolutely.
Why not? Keep in the press, guys. Keep in the press. That's what you're good at. So first up on the main list was Vinod Khosla this week suggested that the US government could take a 10% stake in all public companies to soften the blow of AGI. So this was along the lines of a new way to redistribute wealth, kind of smatterings of UBI, maybe something for Rachel Reeves to consider. But I thought, again, going to your point, Mads, world famous VC in the headlines on the TechCrunch stage, having an opinion. But I always also thought, is there anything in here that we should maybe unpack a bit?
Look, I think we've talked about sovereign wealth funds before. I think it's absolutely right that we find ways to invest assets smartly. And I think governments should be run much more like businesses. And I think some of the smartest governments around the world have found a way to do that, Singapore being a prime example. I think they should preferably buy rather than take. I think we've got plenty of expropriation already. I don't think we need more taxes or confiscation of assets. But to the extent that governments can find ways to allocate resources to get into some of the best companies and get some upside for citizens, I think that's a good idea. I think it's all about kind of the way to get it done.
I mean, well, I think he was kind of positing 10% of all public companies. I don't know how that would work.
That sounds like pure communism to me. I don't like it very much.
In the socialism.
Yeah.
Well, it is. It's nationalisation with a different branding, right? It's partial nationalisation. I mean, it's essentially a form of tax.
But do you think it would work,
at its
Andrew?
edge? I'm not saying it won't. I haven't thought about it. He's an incredibly smart guy. I think there does need to be a rethink about more imaginative ways, more radical solutions to the issues with the coming AI shift, but also just how you fund governments in general, and how governments can realize value from large corporates and successful businesses that have got very good at avoiding almost all taxes in some cases. So I think there is an open debate, and this is a great way to kick it off. I don't know if that's the right solution.
I think it opens a fascinating discussion, which is the following, and maybe we can use the UK as an example, which is that if in the extreme case, AI takes all jobs, right? Let's just absolute extreme.
Well, thought experiment it out, yeah.
Yeah. You know, half the UK takes roughly 1 trillion a year in tax, right? 1 trillion pounds. 350 or 320 billion of that is income tax from income. 220 billion of that is national insurance, which is effectively income tax. So half of the tax take of the UK, yeah, is from income of employees who do jobs, yeah? So ipso facto, if the robots and the AI take all the jobs, the government automatically loses half of its income. At the same time, you say, well, what are we going to do to people because they don't have work now? And you have this concept of UBI, let's say. So then you have to increase the payments you need to make. This is the UBI. So in a way, the government loses half of its revenue and has a much bigger bill to foot. So then you're like, what the hell is going to happen here? You know, Vinod talks about, you know, taking effectively equity in companies, and that's a way to fund the gap from the dividends from that. I think it's a nice provocative thing of him to say. I mean, it's a thing that it's the kind of thing people say in a bull market as well, on the assumption that everything keeps going up, which doesn't always happen. But he has got a point. So there is a broader discussion here. Clearly, that isn't going to happen overnight, and it may happen never. But it certainly is something to think about. And clearly, there are ways around this. And there's, you know, do you tax compute? Do you tax robots? Do you tax? You don't need all these things. Do you tax? All of this stuff is going to have to be considered at some point.
Well, one of the good things about one of the positive things about it would be align motivations. So the current model, you know, governments tax profits, which means there's misalignment. Companies are incentivized to find loopholes, offshore structures, minimize their tax burden. Whereas with an equity model, the government return is directly in line with the market value of the business. So I feel as though those incentives flip. I mean, you then the government's pulling on both sides, but it would certainly mean a fairer outcome that reflects the market value in terms of what the public purse ends up, you know, getting an upside on. Practically, there are some challenges with that, but maybe a middle ground would be something like the government taking some of the taxes and then recycling them into an index fund across certain verticals or across certain investments, so that there's a hedged bet across some of these sectors, some of these companies in public ownership, which it can realize profits from, which again would be aligned with market upside.
But by the way, sorry guys, just I mean, we like the better the AI companies do. Okay, so this is a concept that we already have, which is that the better AI companies do, the more profits they make, the more corporation tax they pay, the more money the government makes. Now I know
this is Andrew's point.
I know. I know that gets cut across by profit shifting and all that stuff, which there's a whole industry, people trying to, you know, base, you know, the whole, whatever, the base erosion, profit share, all of this stuff is governments are trying to work on this. But don't forget, like, there's already ways for governments to capture value, because I think in a way it's very dangerous to tie even more closely the prosperity of a nation with the stock market. You can't tie, you know, that these things are different things, right? I know they're sort of broadly correlated, but I think tying them even more closely together is not necessarily a smart thing to do.
They're indirectly tied already. It's just that
indirectly, but I'm saying
the motivations aren't tied. That's the problem.
Mads, we might need your polymath brains on this. Would this work?
I mean, if we tax stuff, we'll get less of it. I don't think we need to start confiscating people's businesses, but I do think we should find ways to have more efficient government. The problem is we're spending too much all the time. This is straight back to your line from above, right? With the challenge we have now is that the US is spending like drunken sailors. At least they have some growth, but the deficit is absolutely crazy. In Europe, the challenge we have is we're spending slightly less, but we're not growing at all. Okay,
US is spending 1 trillion a year on interest payments. 1 trillion a year.
It's nuts. 6 to 7% deficit in peacetime. It's just like, what are you guys thinking? So we've all lost our senses. And what you need to do is to run a society where you have a little bit of a balance, right? A little bit of a better balance, a little bit of a surplus. You can reinvest some of that, as Singapore does, as Norway has been doing. So you put stuff aside for a rainy day and create, wealth stock you can use later. But the challenge we have is that's not our political system is not very well set up for that, because it's in everybody's interests as politicians to promise more things to voters so you get elected. And so that's perhaps the real problem we have, is kind of this asymmetry, right? Where people that want to take a disciplined approach, they can't get into office, and people that will promise everything and kind of run massive deficits, they get elected. So you have sort of this negative spiral.
The value exchange that kicked all of this off, though, was interesting, with NVIDIA wanting to be able to sell chips to China. My understanding is that's the government took a chunk. Basically, well, if the downside is, if you're hawkish, you're feeding the monster with these chips. So there better be some public upside for doing this, and one of that upside is
where do we get to with the
billions in
Blackwell
cash.
chips? I saw at time of press, we're recording on the Thursday. I saw the Trump Xi new accord. So
well, if it's signed, it's got to they've got to agree the paperwork and actually sign it. Then it's going to last a year. So I think for me, this feels like more. I don't think it means we're suddenly friends.
No. But we've tacoed it up. So we've gone in 100%. Oh my god, we're going to crush kittens. Oh, okay. Well, we'll cut that 20% to 10%, and you can give us some rare earths, and we'll play nicely with you. And can you please buy some soybeans? So it feels like we've kind of got the egocentric out of the way. It feels like there might be, but I didn't know where they got to on the Blackwells. Was that part of the deal? Does anyone know?
I am pretty sure Trump wants it to be part of the deal, because he's now negotiated an agreement where he gets part of the upside from any chips NVIDIA sells to China. The Chinese, they took a bit of offense, right? They did a 180 on it. They said, well, we're not going to buy your chips. But of course, they're going to want Blackwells if they can get them. So my expectation is that they'll find a place where China can buy Blackwells and Trump can get his cut, and NVIDIA can keep growing stock price, and everybody's happy.
Yeah, because their mantra is, we're going to go nationalistic, and we're going to buy all within our own borders, and we're going to become completely self-sufficient, which I don't know how they can, because they actually rely on the US for quite a chunk of chemicals.
Does that remind you of anything? Somebody saying, you don't want to play with me? Well, I don't want to play with you either.
By the way, if you did the numbers, 10% is actually not that much. The market cap of US public equities is roughly 60 trillion. 10% $6 trillion. I mean, it's a lot, but imagine even if they could get 10% yield out of that every year.
It's more than the UK GDP.
I'm talking about in the context of the US, for example. Let's imagine you took 6 trillion of assets, right? And even if you could generate a 10% yield out of those every year, that's not even going to pay your interest payments if you're the US.
What's
right?
S&P average been? 8% year on year?
It depends over what period. Over what period?
Yeah, no, in the last 10 years, it's been more.
Is it? Okay.
But yes, Lomax,
better than most venture funds, put it that way. Hopefully not ours.
But not anybody on this call.
Yeah, exactly. So the LPs listening, what I would say is, final thing that staggered me a bit is that 6 trillion. You know how big the Norwegian sovereign wealth fund is? Nearly 2 trillion. It's 1.75 trillion. So you're like 5 million people who have the kind of access to that. So it's it's staggering, really.
Yeah.
Quite frankly.
Yeah. Well, let's stay on money. I mean, I think this might be a very quick segment, but we are going to, no groans, please. We are going to talk about the UK budget. It's on November the 26th. I was reading some sound bites from Rachel Reeves. One was both tax rises. I can't do the voice. Both tax rises and spending cuts are options. Okay, right. Just softening the way. The OBR is likely to downgrade productivity forecasts for the UK. So we haven't got a great backdrop here. The Institute for Fiscal Studies has calculated that for every 0.1% downgrade in the productivity forecast, government borrowing would increase by around 7 billion. So this isn't a super great place to start. Now, what does this mean for investors, founders? What's going to happen? I reckon there will be changes to capital gains and inheritance. There will be a mansion tax. More positively, will we see business tax changes, perhaps? EMI scheme changes that have been kind of mooted and touted, perhaps? The Startup Coalition and Boardwave, who are two London-based lobby groups for UK tech, have basically asked for just some smart thinking around this. But what's the reality? What's happening? Lomax, what's your thoughts on this one?
I don't want to spend too much time on this. I think personally, I think as always, a pre-seed and seed, early stage, even later than that, head down and build. I really just think ignore what's going on in Mansion House and in Whitehall. Just head down and build. I don't think that there is.
But one thing, one very quick thing on that. Do you think that we'll see more founders leave, go to Dubai, go elsewhere, go to the States? Do you think any? Yeah. This is my challenge.
Because it's not going to be good. The summary of this is it's not going to be a good budget for business, is it? We know where it's going. She's only got one playbook and none of it's good. She's not going to suddenly flip to growth. So nothing to see here. Move along because it's going to just be more bad stuff. Next subject.
Yeah.
I don't think you're going to be moving to Dubai. Quite frankly, I don't think serious founders are going to move to Dubai. They move to the US. I mean, that's a separate point. Okay. You guys know I'm an advocate for founders moving to the US, but that's regardless of what the minutiae of this budget are. But no, she's going to increase spending, if anything, right? Because the two-child benefit cap is going to come away. That's another sort of $3 billion of spending that automatically. So there is going to be an increase in tax. Unfortunately, it is going to go after the taxes that normally hit the wealthy. So the capital gains tax. We look at this mansion tax. But I don't know what we can do. We can sit here and be depressed about it, or we can just crack on with our day jobs. And we have the sort of wonderful thing in our little world is that a lot of this stuff, it sort of matters, but it also doesn't, in a way. As someone who doesn't live in the UK, I can sort of come back and I speak to people about the UK, and there is a lot of negative sentiment, and you can let it get you down. But ultimately, look, I mean, we'll talk about it later. Look at some of the deals of the week. There are some pretty impressive people building some pretty impressive businesses. And, London is the big kind of cosmopolitan global city in Europe, and there's still a bunch of talent there. So I'll try and be optimistic on something that, of course, there's loads of grounds for pessimism here for sure.
Well, I'm gonna stick with heads down and build. I think I'm gonna turn off BBC News and just do exactly that. So, founders raising a lot of noise on LinkedIn, across the social sphere, around founders raising before the pop, getting some cash in the tank, buying some time before a market correction, before the music stops. This is the semi-panic. We haven't got there yet. Mads, do you agree? Is this a good thing, a bad thing, and anything?
Founders need to make sure their businesses are well capitalized. And I suspect the rally we're seeing right now has got several more quarters to run at a minimum. I don't think there's any imminent global meltdown. Famous last words, right? We're going to get Black Tuesday next week.
Just jinxed it.
But no, I mean, we've just seen the earnings come out. We've seen the messaging from not just NVIDIA, but also the hyperscalers. This is not going to go away, guys. We're on the train here, and it's accelerating. I think it's smart for founders to have extra runway if you can get it. I would caution against sort of panic stations, because now's the time to make hay. The sun might never be shining more in our lifetime than it's shining right now on our industry. So, sort of hunkering down and doing defensive rounds and all that stuff. I mean, if that's where you're spending your time right now, I'd say it's a little misguided. If you're in venture, your job is to create growth, and now's the time.
I think, the best, I could say the best founders, but certainly some of the best founders that I've worked with are always raising money, quite frankly. They'll open a note as soon as they close one round and bring in capital selectively through that journey. And it's not the kind of come up for air, raise money every 18 months that maybe people were used to back in the day. So if there are opportunities to strengthen your balance sheet without causing undue distraction to your business development, your hiring, your product efforts, then for sure, that those should be taken. I mean, it's easier said than done. It's all very well for us to be like, oh, well, go and shore up your balance sheets, or make sure you got a robust balance sheet, because, for vertical AI companies or any companies in AI, it's probably, as a generalization, easier to raise money. If you're not building in those areas, it's still not that easy to pull money in at the early stage. So raise capital where you can. It doesn't necessarily need to be all hands to the pump on the fundraising side. But it's the usual advice of you need to have at least a decent runway to enable you to execute the business plan.
Yeah, startups are all about speed if you're on the venture journey. And if money can help you accelerate, you should take it. And actually, even if you're going to even if it can't help you accelerate today, but it will help you accelerate later, and you can take the money today on great terms, you should also take it, because for all these reasons we're talking about, because of cycles, because fashion, because of emotion in investors, also because of just funding cycles. I mean, I think the AI bubble is less likely to burst before money runs out in VC coffers to sort of invest into AI. I mean, VC is cyclic. VCs are struggling at the moment to raise. At some point, those who are deploying are going to get to the bottom of their bucket of cash. Will LPs, will there be enough public market activity? Will there be enough liquidity that LPs start reinvesting into VC so that money trickles down to the startups? We don't know. So yeah, my advice would be, if you can, and is my advice to my portfolio, if you can take money now on decent terms, you should take, and not prejudice on valuation or dilution, you should take it, and be disciplined about not spending it if you're not ready to spend it.
Yeah.
The best companies raise every 12 to 18 months, if not sooner.
6.
Well, yeah.
In AI, that's the AI crowd.
No, the absolute best companies raise money every 6 months. I'm happy to fly.
Well, yeah, okay. The absolute best raise even less than that. I mean, you take Aerospace, 11 months, it went from pre-seed to seed to 100 million for its Series A. So there's always
that's
exceptions
pre-product
to the
market
rule.
fit, that company, by the way. So I wouldn't use that as an example, but yeah.
Well, you were talking about best of the best. So the best of the best are always going to be outliers. But if you're a founder, go get, make sure you got money in the bank. But on the flip side, as an ex-founder myself, don't try and raise if the market will not give you money, because instead of fixing the problems with your business, you will spend all your time trying to find someone who you can persuade to give you cash when your business is not ready and your startup's not ready. So, if that means that you've taken pre-seed, you've done a pre-seed extension or whatever these stupid rounds are called now, and you haven't found product market fit, you better make some radical decisions to reduce your team and solve the problem in your startup before you go back to market. You see a lot of founders out there trying to raise, and it's not easy because the market's not ready to give them money. And what they really need to do is be honest with themselves about what the problems are with the business in order to make you invest.
Sure, but the challenge, Andrew, as you well know, is that most founders don't know where that line in the sand is on the time box, right? It only takes one. It's like buying a house. You need to find the one magic thing, or the one magic car, or the one magic partner. So I don't know.
But what you mean in terms of investor, or in terms of your product, so that the
no,
product
in terms
works?
of investor, in terms of sometimes there are going to be a bunch of naysayers, and I don't know where you draw signal over noise.
Well, I think anybody who's had product market fit with a product, you can feel it. The market pulls you with the product. If you're for 12 months, you're banging your head against a wall, which I've done many times. Your timing is wrong in the market for the product, the right product at the wrong time. You haven't gone to market and got in front of the right people with the right message, or you've got a vitamin, not a painkiller. And that's the most common thing I'd probably say, is that it's a vitamin, not a painkiller, and that's why the market's not.
Or a positioning problem. Sometimes there's a sales problem. Right, let's move into Mads's happy place. It's AI corner time. AI corner. Unsurprisingly, very NVIDIA focused. By the way, did you see Jensen Huang saying that AI isn't a bubble? I thought that was an interesting. That was it. And then he forgot. He started talking about all of the products that he was using, and he forgot. I think it was 11 Labs. He forgot the name of some of the products he was using, so he kind of lost his own train of thought mid positioning the fact that AI isn't in a bubble. Or we buy loads of these things. I don't know who they are, but anyway, that was quite cool. They are the first company to hit 5 trillion. I saw they invested in Nokia this week, and Mads, I'm going to ask you about that, because that I just thought was a really odd thing to do. And we won't forget about OpenAI, who've now completed their recap and are now in their for-profit position. But Mads, kick off. NVIDIA, what's cooking?
First companies just say to hit 5 trillion. I mean, I just think it's a staggering thing, right? You've never seen anything like it before, and it's gone so fast. It's been a great week for them. You've got the China deal, which I think could open up to Blackwell exports, and that will be meaningful once it lands. You've got expanding capex from the hyperscalers. I mean, this is the thing. Every time we have earnings season, everybody is waiting with bated breath to say, look, are they going to keep spending? And yes, they're keeping spending. Google, we've seen earnings from Google, we've seen earnings from Microsoft. Both companies are spending almost all the cash they're generating on capex for DC AI build out. Okay, so Microsoft, they're generating about $45 billion a quarter. They're spending 35 right now on CapEx. Google generating 48, spending 23, but it's increasing. And every quarter, they're adjusting their forecast for how much they're going to spend on CapEx up. So
How much is that? How much of that is going to NVIDIA, Mads? 60%, 70%?
Yeah, probably. Yeah,
about
probably.
60.
A lot of it is the shorter term. Of course, some of it will be the power and the facilities themselves, but a lot of it is shorter term, like stuff they're gonna buy, invest in, and then write off over a few years. And they're seeing massive revenue growth as well, right? The cloud businesses right now, Azure and Google Cloud are both growing at about 40%. Think about having $100 billion business growing at a 40% rate.
Yeah.
Wow. So it's staggering. Jensen Huang, he said that we've got $500 billion in AI chip bookings throughout 26. So $500 billion of revenue backlog. They've got a total dominance in the data center market, right? Above 90% right now. There is a paradox we're seeing, which is that on one hand, the hyperscalers are spending a ton of cash with NVIDIA, which is what's really boosting the stock price. But at the same time, they're all building their own chips.
Which they have to, no? They have to.
Yeah.
Well, we desperately. I mean, the one thing that those numbers show about NVIDIA is we desperately need a competitor.
Oh,
I mean,
absolutely.
That
And it's hard to
control.
dislodge them. But I'd say any economic analysis will say, look, 56% net operating income, net operating margin, it's just not sustainable. And, with the best one in the world, they will stay a formidable player, but that margin will come down. There's no way it doesn't. In between what the hyperscalers are doing, what the startups are doing, competition from China, this will change.
Also, it assumes there won't be a step change in technology. We've touched on this before. There are
100%.
so many companies deploying, including some in our own portfolio, trying to deploy and developing chips that are faster, cost less, use less energy, different architectures. One of those is going to work. One of those is going to win.
At some point.
Some point.
And we're going to touch on Nokia in a minute because this is another masterstroke from Jensen. But he's built such a formidable set of moats, right? The 5 layers. He's got the Mellanox networks. He's got CUDA. He's got all the different compilers and transpilers, and then of course the hardware itself. It's absolutely brilliant.
One thing about NVIDIA. There are so many like assholes in big tech, but like with Jensen, aren't you like it couldn't have happened to a better bloke? Seriously, don't you think?
You don't know what goes on behind closed doors.
I'm sure he's ruthless as
I've not had tea with him, Lomax. Have you?
I know, but I'm just like, maybe he's ruthless as hell. But like, seriously, what a man. And we're celebrating the 5 trillion today. So, I just thought we'd take
absolutely. No.
Fair.
Hats off and everything else. Listen, of the 80 analysts that are covering, kind of Wall Street analysts that are covering the stock, there's one sell rating. Nobody is daring to bet against this guy.
Did you read that guy's report, the sell rating? I guess he's just saying there's going to be competition, right?
Well, I think at the end of the day, that is the analysis. As you look at the profitability and you're like, this is not sustainable. Like it's just gravity.
Either that or he's fired.
Yeah, he's out tomorrow.
When they start replacing the chips in existingly built data centers that would have been built, 3 years ago, doesn't that just keep feeding this machine? No? I'm interested to know what the breakdown is between new data centers and then ripping out and replacing chips in old data centers, because that's going to come online for them probably in the next 24, 48 months, no?
Well, so to be fair, the hyperscalers are all doing 6 years now of CapEx depreciation, not 3.
Okay, fine. Okay.
Which I think is probably and possibly a little optimistic. But
yes,
otherwise, the P&L doesn't hang together.
Cook the butts, baby.
Okay.
Right? You think about it. If you're spending your all the cash you generate on CapEx every year, if you're saying it's only going to last for 3 years, it's kind of the margin's it's just not great. So let's shift to Nokia and talk about what's happening there. So
I'm so intrigued by this. Well, what's because you said it's a masterstroke, right?
Yeah, I think it's brilliant. So Nokia, they're great on next generation networks, right? They build the 5G and the 6G switches that are going to come up. And one of the things you're looking at is to put GPUs into the edge, in the switches, in the radio towers or close to them, so you can do 2 things: optimize the performance of the networks, and provide AI on the edge.
Interesting.
So
But
Jen's-
where does that fit though, Mads? Where does that fit with? I mean, I've always had, for many years, I've had this theory that we're not going to run on cables. I know there's billions spent on 4, 5, 6G licenses. I know the infrastructure won't allow this, but surely Starlink and Musk have chipped away at that thinking. I've always wondered, at what point are we not going to have low Earth direct connectivity, which kind of circumvents this requirement for these mobile networks? Slightly tangential, sure, but I don't know if anyone's got any thoughts on that.
Yeah, it's possibly a little bit. I mean, I think so. Jensen, he's dropping a few billion into Nokia here. I mean,
Just
in the context of a $5 trillion market cap, frankly, that's a rounding error.
Coffee money.
Exactly. But thinking about it in the context of, we already have the full stack of the data center from the GPU and the networks and all the software that sits on top. Now we're moving out of the data center to the networks, the 5Gs, the switches. It's brilliant. And who knows? Maybe the next play he's going to do is going to be a low Earth orbit satellite radio comms play.
You got to be in it, and there's no downside to doing this really, because A, there's going to be transition, and B, it will just lead the way to wherever it goes next. So fair play.
I think that's right.
And what's happening at OpenAI? Any thoughts on the recap?
Not really. I mean, this is sort of stuff we've been talking about for ages and ages. I think maybe the most interesting thing is not OpenAI, which now finally got done what they wanted to do, which is to become a sort of a for-profit, but it's the Microsoft angle. So they've invested just over $10 billion, maybe in real cash terms. A lot of it was credits. Maybe it was sort of 8-9 billions of cash.
Are they still is it still a friendly relationship?
I don't know how friendly it is. I think Satya put on the thumb screws. He's the biggest shareholder, the second biggest shareholder in the company. They now own OpenAI shares worth in excess of $110 billion on the back of a $10 billion investment.
Yeah, friendships be damned. Fine.
Satya, he's the best VC in Silicon Valley, right? It's brilliant.
If you want exposure to OpenAI, you just invest in Microsoft then, right?
Well, and the Microsoft stock has done very well. So no, it looks super smart. They've also done a ton of stuff behind the scenes around. They have a 90-day exclusive access to new models. They're going to be the exclusive cloud provider. Lots of agreements around licenses. They have, kind of pre-AGI licenses, like pre-AGI tech. They'll have licenses to even after kind of this nebulous AGI is achieved.
I thought we'd moved on from AGI. I thought it was all SI now. I thought AGI was yesterday's news.
It still somehow found its way into this agreement, I think. So no, Satya looks like the real winner here. Smart
I
move.
actually think this week is an important week with the NVIDIA at 5 trillion, and I think just this OpenAI, moving on to the next chapter. I think it's an important thing. I know we've been talking about it, and actually, it's vindication for some of the investors. People like Josh Kushner at Thrive, all those guys who put a lot of money into this company, or Vinod Khosla at Khosla put a lot of money into this company when it was slightly weird non-profit organization, hoping that
Always back the founders, baby.
That the issues would resolve with Microsoft. I mean, I guess you could have anticipated that, but. Actually, look at Thrive did a billion at 150 billion valuation. They're now sitting on a kind of 2.5-3x return for that's a lot of carried interest in there. Right.
So don't forget there is obscene amounts of stock-based compensation in these groups.
Yeah.
So the paper markups may not be quite as attractive.
That's a very good point.
As
So basically, what you're saying there is that basically there's a huge ESOP, right? There's lots of options issued to employees.
Yeah.
It's good. Lots of
Do you
recycling.
think this opens the way
lots of
for OpenAI to IPO, Mads, or not?
I'm actually not sure. Well, that's certainly the plan, and they do want to IPO. I think I saw 27 as the timescale. Yeah. I think you're right. It's super important. I think these massive companies should be public. I think it's really important.
Any more on AI Corner, Mads Doodles, before we move on?
Talk about AI all day, but I know you want to move on.
I know.
So let's go to deal of the week.
It's just
Meta didn't have a great earnings season, though.
We never talk about Meta, and that's fine by me, to be fair. But I mean, Meta never never takes any oxygen. Which, unless you have something, Lomax. Did you have a meta little news?
Well, no, interesting. Did you guys see that Meta got rid of 600 AI employees in their team last week? They announced that, which is sort of
I
a bit
saw loads of
counterintuitive.
layoffs. I mean, we're not talking about just in big tech hyperscalers or other. I saw there were thousands of layoffs this week across retail, Amazon, tech, blah 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 blah. So maybe that got lost in the noise.
No, it was out there. I think there's slightly different things they're touching on. I think Amazon was kind of the headline piece, right?
Yeah.
And we've been talking about how AI is causing unemployment and people are being laid off. I think there's a different theory here, which is that large companies just can't do performance management, right? They're really struggling. You got hundreds of thousands of employees, and every few years you need to weed out a bit because, right? And that's what they do. And the numbers, the absolute numbers look big, but what is it? 1% of the workforce, 0.5%. If you just think about it in terms of normal attrition for a company, right, at that size, you should have tens of thousands of people leaving every year just because they move to other jobs or retire or whatever.
It's just a press framing. It's obviously if 1 week Amazon are talking about not laying off people and using AI inefficiencies to grow, and then the next week we're leaving or losing 30,000 people. I think there's obviously a strong press angle, that clickbait, click rage press angle where they have to
But
maximize.
I think if you look at
the
the Q3 reports, I mean, Alphabet delivered a record 100 billion in Q3 and boosted its capex plans, and actually shares moved upwards, right? However, Meta also delivered good numbers, up 25% Q on Q, but and will be announced more capex spending of 100 billion next year, and their shares dropped by 12%. I think, as I alluded to earlier on, I think the market is a little bit unsure as to what, I think we probably on this podcast are a little bit unsure as to what Meta are really actually up to. And so I think that's been priced into the market. Well, I don't know. I mean, I've said before, never bet against Zuck, but I think they're at risk of getting a bit orphaned here, potentially.
He's not had a good year, right? Llama 4 was a disaster.
Well, you're going to use a different word then.
Lots of attrition, and they're out of the top 5 now. Top 5 open source models are now all Chinese.
Well, they were originally American until they were ripped off and made Chinese. Is that fair?
It's not that as if Zuck is not spending the money, right? I mean, he's been trying to hire the best of the best, but they just have not been able to keep up. I mean, we can say rip up all we like. I mean, they could rip right back if they wanted. All the Chinese models are open source. It's not as if it's a secret what they're doing.
Yeah.
They just seem to be working a little bit harder right now.
Yeah, interesting. Well, let's move on to deal of the week. I've got one. I thought this is kind of fitting to previous conversations. Warsaw-based Sales Patriot have just raised 4.2 million euros to modernize defense procurement. It's an American-Polish startup. They're looking to expand into Europe. I thought it was kind of cool listening to founder Nelson Ray saying things like they're building the infrastructure to make sure the West is ready. I thought it was quite punchy. But we all know that procurement in defense is awful, sticky, a terrible mess, and they want to become the system of record. So I big rah-rah to Sales Patriot. I hope you do well. Lomax, you got
there's
one?
a long tail. We now know there's a long tail of tiny, contractors. So, maybe these guys help on the go-to-market for them. My deals of the week, talked about one of them earlier, is in no particular order, Legora, who legal tech AI startup out of Stockholm, has just raised 150 million at a 1.8 billion valuation. This comes only 5 months after their Series B in May 2025. So good companies raise money every 6 months, maybe even less.
Well, I would never, ever in a month of Sundays thought we would say that about legal tech. Give it,
Well, I mean, as I used to be a lawyer, I used to be very bearish on this. But clearly, LLMs have unlocked a huge potential. However, before we all run away looking for the next hot legal tech deal, Robin AI, which was another kind of hotly touted legal AI company, legal tech, is basically put itself up for sale. The company has raised 70 million from pretty good investors, including Plural, among others, and has just failed to complete a $50 million round and is effectively shutting down. So while you have Legora on a tear, you have seemingly Harvey AI in the US on a tear, you have hasn't worked out for Robin, which
do we know
for
what
the UK, we don't know. I know. Well, I mean, it's the usual kind of we expanded too quickly, we hired too many people, we opened too many offices, that kind of thing. But is it an issue with the product or the go-to-market? I mean, I'm sure there'll be more stories coming out of this because this is breaking as we as we speak. Next up, Bending Spoons, we talked about buying AOL, and the other deal of the week I think is Synthesia, who've just raised 200 million at a 4 billion valuation. That they recently, you may have read, have done something very un-European, which is they turned down an acquisition offer from Adobe of 3 billion. I know. That's not very English or European of you. Normally we're like, oh, give me a few hundred million and, we'll rush off to Cannes. They turned down an acquisition offer at 3 billion, have now raised at 4 billion. So congrats to those dudes. And, goes back to what we're talking about, Rachel Reeves. You can pontificate about all that, what's coming up in the budget. But at the end of the day, these are global companies, global go-to-markets. And if you can build, there's great talent in London. There's the ability to get companies off the ground. And so let's go for it.
You go.
Yeah.
Well
LFG,
done.
as they would say. Yeah.
Yeah. Well done, Synthesia. Any more before we close off, my lovely humans?
Well, I saw an interesting. UK is very big in quantum, actually. I think it's one of the areas.
Europe is big in quantum, right?
Are you starting to talk about your own book, Andrew, again?
No, I wasn't actually. I wasn't, in honesty.
Is there a 7% deal of the week squeaking in?
I mean, there might well be very soon.
There will be soon, and it might involve outsized as well. But yeah, okay. Keep
I'll
going,
behave.
Andrew.
I was actually referring to a company. It is Ion Trap, when we have an Ion Traps company in our portfolio, but it's not them. It's a company called QFX, an Oxford spin-up backed and led by Paul Graham, who you will remember.
He's done a bunch, isn't he?
Is founder of Y Combinator, but now based out of the UK. He moved back to the UK. And I just think this is interesting because sort of compared to any other sector or a lot of other sectors, the UK has a disproportionate number of quantum computing startups, but also quantum startups in general, probably 2 to 3 times the number in Germany or that in France, and not far behind the US, actually. So it's an area that I think the government's finally waking up to, and will be super interesting as this stuff comes of age.
It's a great point. Don't forget that that 2 or 3 of the poster childs of quantum, which include PsiQuantum and Quantinuum, which have now become US organizations, were both UK projects, one out of Cambridge, one out of Bristol. So actually, in critical infrastructure, UK's played a big role in the future of quantum. Oxford Ionics, obviously earlier, 3 months ago, got bought for 1 billion by IonQ. So as you say, it's a good thing to highlight.
Can we keep them? Is the question.
Don't you dare end on a downside. I will have you. Well, anyone got anything exciting planned for the coming week? Any surfing trips, Lomax? How was SF, by the way?
He doesn't have to go on a surfing trip. He just steps out of his office and he just starts surfing.
Monday, Wednesday, Friday, lunch
out
break.
The front door.
Yeah. How was SF?
Good. It's funny. I'm going to say this. I'm going to say this as fact that we've got some American listeners. I forgot how flaky Californians are to arrange meetings with. I used to live there, but it was it was over 10 years ago. And I forget that you kind of have to, when you say, oh, do you want a meeting? They say, yeah, let me know when you're in town. And then you tell them when you're in town, and then they're too busy. And they say, well, meet me next week. So top tip I always tell founders or anybody wanting meetings, which I remembered having gone back there, is tell people you're in town the week before you're there. When they say, if they say, I'll meet you Thursday, you say, well, my diary is full, but I'll meet you on Monday. Pretend you're there for 2 weeks. Try and arrange all your meetings in the first week for the following week.
Love it. Good
top tip.
Good tip. There you go. Top tip to end on. Gentlemen, what a pleasure and a gift. I'll catch you all next week.
Bye.
Bye.